Welcome to the BDI Empowers podcast, where experts simplify disability benefits so you don't waste years figuring them out. Now, get empowered.
Hello, and welcome to the BDI Empowers podcast, where we break down complex systems into clear, practical information for people with disabilities and the people who support them. I'm Anita Gardner, Director of Trust Services here at Bobby Dodd Institute. I dove into the disability community when my daughter was diagnosed with autism at 2.5 years old, and I've been here ever since. I know firsthand how overwhelming financial systems and benefit rules can feel and how important it is to get them right. Today's episode is all about two very important roles that often come up when someone receives disability benefits: representative payees and trust representatives. These roles exist to protect benefits, manage money responsibly, and support long-term stability. But they do very different things. By the end of this episode, you'll understand what each role is, what responsibilities come with each, and why these roles matter so much, and when someone might need one, or both. Let's start with the representative payee. A representative payee is a person or organization appointed by the Social Security Administration to manage someone's Social Security benefits, most often SSI and sometimes SSDI. The person receiving benefits is called the beneficiary, and the representative payee's job is to use those funds only for that person's benefit. These benefits are meant to cover basic living needs, such as housing, food, utilities, clothing, and medical expenses not covered by insurance. A representative payee must receive the Social Security funds into a separate account, pay bills, manage a monthly budget, keep detailed records and receipts, report changes to Social Security, and complete required annual reports. This role carries legal and ethical responsibility. If funds are misused or rules aren't followed, it can lead to overpayments, benefit reductions, or even loss of eligibility. A representative payee can be a parent, sibling, spouse, trusted friend, nonprofit organization approved by Social Security, professional payee service, a court-appointed guardian, or certain institutions like nursing facilities. Every payee, individual, or organization must go through an application, interview, and approval process with Social Security. Before choosing or becoming a representative payee, it's important to ask, can this person manage money accurately and consistently? Do they understand Social Security rules? Are they available long-term? Can they separate personal relationships from financial decisions? Now let's talk about the trust representative. A trust representative manages money held in a special needs trust, either an individual trust or a pooled special needs trust. Unlike Social Security benefits, trust funds are not income. They are assets set aside to supplement, not replace, those benefits. A trust representative acts like a fiduciary, meaning they must act solely in the beneficiary's best interest. They manage trust funds according to the trust document, make approved disbursements, keep detailed financial records, provide annual accountings, and coordinate with Social Security and Medicaid. Trust funds are typically used for medical or dental care not covered by Medicaid, therapies, transportation, education, technology, personal care supports, or recreation and quality of life expenses. The goal of a trust is long-term stability, sometimes lasting a lifetime. So who can be a trust representative? A trust representative may be a family member, trusted friend, nonprofit organization, professional trustee, bank or a trust company, or a court-appointed trustee. Keep in mind that this role requires strong financial and record-keeping skills, knowledge of Social Security and Medicaid rules, understanding of fiduciary duty, long-term availability, and clear communication skills with families and agencies. Let's clearly separate these two roles. In terms of authority, representative payees are appointed by Social Security, while trust representatives are named in a trust document or by a court. They manage each different types of money. Payees manage monthly benefit income, while trust representatives manage assets set aside for the future. They each serve a different purpose. SSI covers basic needs while trust funds improve quality of life. Different budgeting focuses are required for each role. Payees budget month to month survival expenses, while trust representatives budget for sustainability and supplemental support. It's important that these roles stay separate, even when one person serves in both capacities. Budgeting recommendations. Let's dive deeper into budgeting. Budgeting is not optional when someone receives benefits or has a trust. It's essential. So let's talk about some practical budgeting recommendations that can help representative payees and trust representatives do their jobs and avoid common problems. The first recommendation is to create a written monthly budget. For representative payees, that budget should clearly show monthly income from SSI or SSDI, rent or room and board, utilities, food, transportation, and medical or personal expenses. This helps ensure that basic needs are covered first, every single month. SSI is meant to support survival. Housing, food, and utilities must come before discretionary spending. Another key budgeting recommendation is to clearly separate basic needs, which are usually paid with SSI, and supplemental expenses, which may be paid from the trust funds. Trust representatives should budget with the understanding that trust money is not there to replace benefits. It's there to enhance quality of life. Things like therapies, technology, education, transportation, or recreation. When these lines get blurred, that's when benefits can be reduced or even lost. If someone has both a representative payee and a trust representative, or one person serving in both roles, coordination is critical. Budgets should not exist in isolation. Instead, the representative payee's budget should show that basic needs are already covered, and the trust representative's budget should show supplemental spending without duplicating these costs. When budgets work together, spending decisions are clearer, safer, and easier to justify if questions ever arise. Another recommendation is to plan beyond just month-to-month expenses. Budgets should account for annual or semi-annual costs, medical or dental expenses that don't happen every month, technology replacements, transportation needs, and emergency or unexpected costs. Trust representatives, in particular, should think long-term, not just about what's affordable now, but about how long the trust needs to last. Budgeting doesn't stop once the money is spent. Both representative payees and trust representatives should track every single expense, keep receipts and records, and document the purpose of each payment. This makes annual reporting easier and protects everyone if Social Security, Medicaid, or a court ever asks questions. Finally, budgets should not be set it and forget it. Life changes, rent increases, medical needs change, benefits amount adjust, and budgets must be updated to reflect that. A good practice is to review budgets at least once a year, update them when income or expenses change, and use budgeting as a planning tool, not just a record-keeping task. All of these budgeting practices support the same goal: protecting benefits, preventing crisis, and supporting long-term stability. Now, let's highlight the most common mistakes. These mistakes include mixing funds between accounts, using trust funds for basic living expenses without understanding the impact, poor or inconsistent budgeting, or missing reporting deadlines. Avoid assuming good intentions override these rules because unfortunately they don't. The rules exist whether we want them or not, which is why education and planning matter so much. And that leads us right into some of the most common questions families ask when they're trying to manage both benefits and trust funds responsibly. Let's walk through some of the most common questions families ask. Can one person be both a representative payee and a trust representative? Yes, but it requires extreme care. These roles have separate rules, separate accounts, and separate reporting requirements. Funds must never be mixed. Do trust funds affect SSI? If used incorrectly, yes. Some trust payments, like paying for rent or utilities, can reduce SSI and must be reported. Why do records matter so much? Social Security and Medicaid can request documentation at any time, even years later. What happens if mistakes are made? Mistakes can lead to overpayments, repayment demands, or a loss of benefits. That's why understanding these roles is critical. Understanding the roles of representative payees and trust representatives is one of the most important steps in protecting benefits and building long-term security. Let's recap. Representative payees manage Social Security benefits for basic needs, while trust representatives manage trust assets for supplemental support. Each role has different rules, responsibilities, and reporting requirements. When used correctly, these roles work together to protect benefits and improve quality of life. You don't have to figure it out alone. Support, education, and guidance are available, and asking questions is always the right place to start. If this episode raised questions for you, or if you want help understanding benefits, budgeting, or planning for the future, support is always available through Bobby Dodd Institute. We're here to help you protect benefits, plan with confidence, and support the people you care about. Thank you for joining me on the BDI Empowers podcast.
This was BDI Empowers, your guide to independent living. Join us again next month to learn more about simplifying disability benefits.